Hey everyone, welcome back to the channel. If you're new here, this is Fundamental Finances, and today we're talking about something super important for long-term, income-focused investors, dividend stocks. Specifically, the top 5 high-yield but relatively safe dividend stocks to buy right now. If you're a beginner wondering where to start, this video is for you. We'll also cover key tips to invest wisely in dividend stocks. Let's jump in. Part 1. Criteria for selection. Here's what I looked at when picking these 5 stocks. Dividend yield, high enough to be meaningful but not a red flag. Dividend history, companies that have consistently paid and ideally raised dividends. Cash flow strength, enough free cash flow to support the payouts. Business model resilience, industries or companies that can weather economic cycles. Balance sheet health, low to moderate debt so dividend isn't at risk. With those in mind, let's go through the picks. Part 2. Top 5 dividend stocks. I'll cover each stock, why it's attractive, its yield, and what makes the dividend safe. 1 Enterprise Products Partners, ticker EPD, 6.3% yield. What it is: a midstream energy company that owns pipelines, storage, and transport assets. Why it's safe: according to The Motley Fool, much of its cash flow comes from fixed-fee contracts, which shields it from commodity price swings. Dividend strength: it's raised its base annual distribution for over 26 consecutive years. Risk notes: being energy-related, it still has some exposure to macro energy risk. But the model of long-term contracts helps. 2 Realty Income, ticker O, 5 to 6 per yield. What it is: a REIT, real estate investment trust, that owns a diversified portfolio of commercial properties. Why it's safe: Realty Income has a very long record of increasing its dividend, 109 straight quarters per NASDAQ, and pays monthly, which is great for income. Business resilience: its tenants include resilient retailers, grocery, drug, dollar stores, which tend to survive downturns. Risk notes: REITs are sensitive to interest rates, and if property markets weaken, cash flow could tighten. But Realty Income's track record gives a cushion. Johnson & Johnson, ticker JN, 3% yield. What it is: a diversified healthcare giant, pharma, medical devices, consumer health. Why it's safe: it's a dividend king, with over 60-plus years of dividend increases, and NASDAQ highlights its defensive nature. Cash flow: strong, consistent cash flows from varied healthcare operations. Risk notes: slower growth compared to tech and regulatory risk in pharma, but as a long-term income pick, it's very solid. 4 Verizon Communications, 6.5% yield. What it is: major telecommunications company, large U.S. wireless carrier. Why it's safe: according to The Motley Fool, it generates massive free cash flow, and its recent financials show a dividend coverage ratio of 1.8x, giving it room to sustain the payout. Business moat: telecom is capital-intensive and difficult to replicate, giving Verizon a stable base. Risk notes: high debt is common in telecom, and competition is fierce. Also, regulatory or tech shifts could pressure revenue. 5 PepsiCo, 4% yield. What it is: global food and beverage company, snacks, drinks. Why it's safe: The Motley Fool points out PepsiCo has paid dividends for decades and has a strong track record of dividend growth. Business resilience: people always buy snacks and drinks, regardless of economic cycles. Defensive consumer goods. Cash flow: generates strong free cash flow, and returning cash to shareholders, dividends, is a top priority. Risk notes: commodity costs, sugar, corn, supply chain pressures, and competition are risks. But its scale helps buffer. Part 3. Tips for beginner investors. Okay, now you've seen the 5 picks. But simply buying them isn't enough. Here are my top tips for beginner dividend investors. 1. Don't chase sky-high yield blindly. A very high yield can be a red flag. Always check payout ratio, free cash flow, and whether the business supports the dividend long term. 2. Diversify across sectors. As you saw above, my picks span energy, telecom, consumer goods, healthcare, and real estate. Spreading across different industries reduces risk. 3. Use a dividend reinvestment plan, DRIP. Reinvesting your dividends can turbocharge compounding. Over time, you'll own more shares, which then pay more dividends. These are not get-rich-quick plays. They're about building an income stream and wealth over time. If you're just starting out, pick 1 or 2 to begin with. Set up a DRIP if possible, and keep adding over time as you learn more. If you found this video useful, hit the like button and subscribe for more investing guides. Thanks for watching, and I'll see you in the next one.